Hello,
Is it going?
everyone, and good evening. On behalf of the Social Activities Committee, it's my great pleasure to introduce our speaker tonight, Mr. Cecil Nazareth, who is going to talk to us about tax planning, international taxes, and also the most recent regulations, FATCA and FBAR. And I'm sure that this is a subject in which all of us are deeply interested in. Mr. Nazareth is the Chartered Accountant, CPA, MBA, and currently the co-owner of Nazareth Global Accounts. The firm has offices spread across the tri-state area. He is an eloquent speaker and has conducted several sessions on topics pertaining to the international tax and personal finances for many, many years. Just wanted to let you all know that the session is for an hour, which includes 15 minutes for question and answers. Since all of you are viewing this through YouTube, there is a text box on the right-hand side where you can post your questions, and we will have Mr. Nazareth answer these for you at the end. Without further ado, over to you, Mr. Nazareth.
Okay, thank you very much, everyone, for participating, and I'll do the best I can. I do several sessions on international tax. That's my core expertise. We are a big firm, three brothers, and we do different areas. We have areas of expertise. My area of expertise is international accounting and international tax. I'm also a professor of global studies at Fordham University in New York City. But I've been practicing in this area for quite a while, both on the India and the US side. And I was the first Indian at Ernst& Young. So I really would pay special attention because international tax is becoming really relevant and important in today's global environment. So we'll feel free to ask as many questions. I'll try to answer as many as I can. I also teach with Thomson Reuters, CCH for most CPAs in the US on international tax law. So without further ado, let me try to walk through a few slides. Uh, Mark, okay, so let's talk with slide 2. There's an international primer. We'll talk about what basically international tax is all about, wealth transfer, US tax law, Indian tax law changes, cross-border transactions, FATCA, and that's not a Weight Watchers thing. It's more Foreign Account Tax Compliance Act, FBAR, tax organization structure, and Obamacare. We'll talk a little. But there's a lot to cover, so in the interest of time for an hour, I'll try to hit on some of the key highlights, what's important and relevant to today's environment, and then you feel free to have access to these slides later on, and if you have any questions, comments, happy to answer them. So can we move the slides, or you want me to move it, Lancy or Bob? Okay, slide 3, we are talking about what's new. This is one of the most important things is FBAR, the date has been moved up. For people who are not familiar with FBAR, is foreign bank account reporting. If you have more than 10,000 in any foreign bank other than the US, you need to report that amount on a form, and it's electronically filed with the IRS. But that date has moved up to April 15th. It used to be June 30th. Second, partnerships date also moved up to March 15th. And if you owe more than 50,000 to the IRS, your passport can be revoked. That's the latest development. Not many people know this, but I practice in this arena. And so 50,000 or more, if you owe the IRS, they have the jurisdiction to revoke your passport and you cannot leave the country. So I think that is a very serious item, and people need to figure that out. Okay, we lost a few.
Hi, Cecil. I just got notified that a few members are looking forward to join the link. Can we give them like a minute? If
Yeah.
that's okay? Okay, thank you.
Hi, Cecil. I think let's proceed. We are already at 8:30, and we'll record this present webcast so that we can people can view it later too. All right. Can you see my screen now?
No, there's something else on the screen.
All right. Give me 1 second. Now?
Yes.
Okay.
Okay, we have slide 3. We are on slide 3? Okay.
Yeah.
And I'll just tell you to increment the slides as we go along.
Absolutely.
Okay, so FBAR, the date has been moved up to April 15th. It used to be June 30th. For folks who are not aware, it's foreign bank account reporting. If you own a foreign bank account and have more than $10,000 in that account, then you would have to file a form with the Department of Treasury and not IRS. It has to be electronically filed. Second is partnerships. The due date is moved up to March 15th. It used to be April 15th. Third, this is a very important fact, and most people don't know this, but if you owe the IRS more than $50,000, then your passport could be revoked and cannot be renewed till you get clearance that everything has been settled. That's one of the most serious and significant changes that has taken place. It's going to be serious, and I urge everyone to take that third bullet seriously. More focus on collecting outstanding debts, and that's where the US government is coming in. Okay, we move to slide 4. Okay, yes, tax optimization for those who still have a chance. I think this was more intended, a lot of tax changes. So muni bonds, offsetting income, capital gains versus capital losses, deferring income. But this was more if June for December year end. We do most of our tax planning in December rather than in April. You can accelerate deductions, and finally you get into a lower tax bracket, capital gains. If you transfer stock from a parent to a kid, you can have actually zero capital gains, and the parent rate is more 23.8%. And finally, avail of education credits, and that is still applicable. A lot of this people who have kids in college, they can avail of $2,500 of tax credits every year. Let's move on to slide 5. So let's keep moving, another slide. And the taxation system, US citizens are taxed on worldwide income. And even if you're physically present in the US for more than 182 days, you could be considered a US taxpayer. Third is you have a credit system, so it's not double taxed. We have a tax treaty, US and India. So if you pay tax in India, you will get a credit in the US for the tax you paid in India, and vice versa. So people misunderstand this whole concept. It's called, it's no double taxation, just you pay whatever income you report in India. And so if you want to use your Indian rupees, that may be a good way to go. And if you have fixed deposits, then tax is automatically deducted at source. And if you don't file a return in India, you cannot even get that back. So I really urge everyone file an Indian tax return and get your money back, and then you can take that credit for in the US. So it's a one-for-one credit. If you pay tax in India, you don't pay tax in the US. That's as simple as it gets. Moving on, slide 7. Sourcing rules, what type of income? So this is where it is earned and where the property is. For example, real estate. If it is in India, then India has the first right to tax it, and then you, as a U.S. citizen, will pay tax based on that income. After it has been taxed in India, you get credit in the U.S. Capital gains is the same in India, 20%, and US 20%, so you're pretty much in the same ballpark. Residency, that US, depending on the number of days you're in India or the US, and citizenship also is another factor. And finally, no double taxation, I mentioned before. If you sell real estate, I get a lot of clients who are selling real estate in India. They pay the capital gains in India, and then they'll have reciprocity when they file the US tax return. So you can get credit for that. Okay, moving on, slide 8. Next slide to 9. Wealth transfer. This is an important topic. A lot of people don't cover this, but ours is a big firm. I have another brother who specializes in estate and gift tax, and not many CPA firms or Indian US CPA firms specialize in this area, but we do. And we can help you with a complete package of gift, estate, and income tax returns. So in a gift tax, you can allow, this is the most, I call it, people don't know this fact and they don't avail of it. You can give a kid, every parent, so 2 parents can give a kid $28,000 every year tax-free, gift tax-free. So That's an excellent idea. So if you had, for 10 years, you'd give to each kid 28,000, so 10 years, it'll make it $280,000, which is a lot of money. And I think a lot of the older generation who have been in the US for a long time, this will be a very good planning tool to reduce their wealth and their estate. Now, estate tax is a high rate of 40%. So if you have more than $5.3 million, there's an exemption. So totally, it's actually 10.6 because you got husband and wife. Now, what I mean by portability, if the husband dies and uses only 2 million, then the remaining 3 million goes to the wife and vice versa. So, but state tax exemptions are much lower, 3 million and 4 million in New York, and it's going up to 4 million. But you want to bear in mind that estate tax is a bigger issue for most people who have been in the US for a very long time and own property, real estate, and 100 other avenues of income. And when they pass on, the tax rate is 40% of the excess above 10 million. So you want to keep that in mind. But gifts are a really good tool for wealth transfer without any tax implication. Okay, I think it's an important slide. And I'm free to push these slides out after the session so you can avail of these and learn a little more. Okay, slide 10. Slide 11 is tax traps. I think this is really important. Phone scams, emails, all clients, no matter who they are, get hit with this. Do not give your social security number, no matter what. And if you get a phone call, tell them contact my CPA or attorney. That's a good way. I've advised all my clients. Our firm has advised all our clients. Just tell them to call us. And when it's a CPA attorney, you're less vulnerable, and we just ignore their calls or call them back. And it's usually they don't call back when you say talk to my CPA attorney. IRS will not call you on the phone. Just remember that. It will be a hard copy. All correspondence is by mail, and that's by law. So they cannot call you on the phone for whatever reason. Now you can call them, they cannot call you. And finally, ID theft. So that's becoming more and more relevant. So I urge you to keep good track of your documents. Your electronic filing is pretty safe, but some softwares are not as secure as the other ones. So just TurboTax at home. I know a lot of clients. They was not our clients, but they did it by themselves, and little knowing that TurboTax was pretty vulnerable and their social security got compromised. Moving on, slide 12. Okay, here are some tax planning tips. So, and this applies year-round. Every year when you're doing your tax, accelerate deductions, defer income. So, for example, real estate taxes you would want to pay in December and not in Jan. Review your financial portfolio and dump stocks. So, capital losses are allowed. If you have 3,000 of capital losses, you can actually deduct it in that year. Any excess will be carried forward. Approve charities. I get a lot of these questions. When people give to charities, you need the approval of that. It should be an approved charity. So it should be a charity which has an EIN number or what we call a taxpayer identification number or employer identification number, a not-for-profit number. The reason being, if you donate to the Red Cross, yes, they have a number. But if you donate to a temple which has no number or send to India directly, then that is not deductible if they do not have an approved IRS identification number. Max out your retirement plans, always good. And if the company matches the contribution, then that's even better. Finally, optimize tax position. I come in situations where people withhold too much, so they get a great refund. They think it's good. That's not good. And if you make too little payments, then you're liable for penalties. So we call it optimized tax position. I had a client very recently, they had about 15,000 with the IRS, and that they're getting a refund of $15,000. And I asked the first question, why would you keep so much money? What happened? He did not adjust his W-4 withholding, and that's 10,000 or 10 to 15,000 was sitting with the government, 10 in the federal and 5 in the state, which was totally ridiculous. And I would not have such a situation if I were filing taxes. Okay, slide 13. Moving along. Increase withholding and estimated payments to payrolls. Payroll is a good vehicle for self-employed business people. Use payroll to withhold tax, because if you do that, then there's less penalty or no penalty at all. Flexible accounts are for healthcare and childcare, etc. Then pay all your state and real estate taxes, like I mentioned. Assume no AMT, because if there's alternative minimum tax, then that won't work for you. and pay all your estimates by Jan 15th. I think it's a little too late now, but you should pay at least 110% of the previous year's tax to avoid any penalties. Moving along to slide 14. This is a good slide for high income earners. So if you're earning some substantial amount of money, 300K, 400 and 300. So MFJ is married filing joint. So your capital gains rate goes to 23.8, and then excess of 250 in earnings is 0.09% of additional Medicare tax. And the two forms you need to be aware of is 8959 and 8960. This is all to fund Obamacare. That's where it came about from. So a tax planning tip would be move an active business and move to an active business. So suppose you have interest income or dividend. Now, if you invest in a real business, then that is not subject to this tax. This is basically, we call passive income and investment income, basically. Okay, moving on to slide 15. Okay, high income earners, section 179 is more for businesses. You can write off equipment in the first year. NIT, I already spoke of it. NIIT is a net investment tax. Now, pay down your mortgage. Here's a tax planning tip. Now, this is for this. Last year, it's 15 is late, but 2016 you can do this. Make 2 or 3 extra payments on your mortgage, and that way you'll get a higher interest deduction. And there again, assuming no AMT. And then finally, charitable contributions. I've always mentioned. Are you there? Okay.
Yeah, here.
Okay, I'll keep carrying on.
Okay.
Say that again.
We just keep ourselves on mute.
Okay. What slide? I'll just carry on. I have a second set of slides on this slide.
So I'm on slide 15 right now.
Yeah. So let's go back to 15. Okay, section 179 deductions on equipment write-offs, net investment tax, pay down your mortgage, and finally charitable contributions. We are on slide 16. Okay, common mistakes that people make: not availing of all deductions or credits. Second is not reporting foreign income. That's very dangerous, folks. Now with FATCA, if they get to know that you have foreign income and you not filed FBAR and you're earning income, you could be in serious violation. And we're going to talk about FATCA and FBAR a little later on. Okay, moving along, charitable contributions, more than 500, you have to document that. Schedule C, I find a lot of issues because people don't substantiate their expenses. I joke that Patel Brothers and Costco is not deductible in a business. You know, the IRS do not make them out to be fools. They sometimes are serious about this. So if a client gets audited, they're going to ask you, what's your business purpose for these expenses being deducted? You know, a certain amount is okay, but down the road, you're just causing too many red flags, and I think it's unreasonable to plead ignorance beyond that point. So I urge you, you know, it should be valid, substantiated business expenses necessary to earn that income, and just not any expenses that you feel is deductible. Refer to the tax code if that has, or ask for advice or consultation. The very fact that someone else takes a deduction doesn't imply that it's deductible under the tax code. So I always challenge my clients and ask them, okay, where in the tax code you see this as deductible, I'm happy to deduct it for you, no problem. So keep on the watch out because they're looking at Schedule C and small S corporations much more vigorously. Okay, moving on to slide 17. Okay, SEP plans is you can still form a SEP plan even now up to the date you file a tax return and fund it. So that may be another way. If you have a major tax burden, then that's a good way to go about. Defined benefit plans, again, you need a substantial deduction. That might really work in your favor, okay? IRA, fund your IRA before April 15th. You have two types of IRA. You have a regular IRA, which is tax deductible, and you have a Roth IRA, which is post-tax deduction. So you can both avail of both. The IRA gives you an immediate deduction. Roth gives you the appreciation is not taxed. Tuition credit, I see a lot of folks just omitting this. $2,500, and I believe lifetime credit has increased to $2,000, not the $1,000 it is here on the slide. So they changed it to $2,000 for lifetime learning and education credit $2,500. So if your student child is in an approved or kid is in an approved college or 4-year degree program in a college, accredited college or university, you can take $2,500 provided your incomes are not on the high income levels. But if it is on the high income, then what I recommend is that the child should get a job, and if they make 3,000 in a summer job, then they can avail of this credit, and it's a refundable credit, so government will give you that money back. And finally, foreign tax credits, you need to file Form 1116. So if you have a fixed deposit in India, tax deducted at source, and you did not file a tax return, then you can pretty much use this form to get a credit in the US side. Okay, so moving on to slide 18. Okay, capital gains rates are three rates, 0, 15, and 23.8. So if you're on lower levels of income, it will be 0. Higher levels 15, and then really high levels above 250 to 300, you're talking 23.8%. Now give the stock to a kid. Here's an example of a good tax planning tip. So take the stock and give it to a kid. The kid will pay no capital gains tax. So all appreciated stock, the kid will inherit the same basis as the parent, but they will pay at a lower rate. So kid pays, if the parent picks this up, the gain will be, the tax will be 2,380. If the kid picks it up, the tax is 0. So consider that as a good planning tool. Okay, moving along to slide 19. Okay, defer income to the following year accelerate deductions. I've mentioned this. All cash basis taxpayers use credit cards to claim expenses. Now, if you charge a credit card to make a donation on the last day of the year, it's still considered a valid deduction. So you can claim this in 2015. Okay, moving along, slide 20. Okay, so Indian law, there are some small changes. I just go through this quickly, but service tax has increased from 12%, 12.3 to 14%. Royalties, there's some debate going on there. Tough penalties for tax evasion. I want to stress the last one. I think that one on the India side also, they're asking a lot of FATCA questions, and we'll come to that in a moment. So moving, could you move the slide along? Okay, moving on to cross-border transactions. Now we're going to FBAR. This is a really important scenario, so I really urge you, everyone on the call, to pay attention. So yeah, foreign investments, foreign bank accounts, foreign real estate, foreign shareholding in S corps and entities. Now real estate is not, if you earn income, then it becomes an issue, but technically FBAR relates only to investment income and bank accounts, and then we'll talk about the other side of real estate and also shares, stock holding in corporations and entities. Now you do get credit for taxes, like I mentioned before. US withholding is 30% of interest dividends paid to non-shareholders. For example, if you're an Indian citizen and you invested in the US stock market and you earn 100,000 of income in the US stock market, then its burden is on the person issuing the dividend. So if you invested in AT&T stock and they know you're a non-resident of the United States, it's their responsibility to withhold 30% of the interest or dividend before they pay you the amount. And same rule applies in India too. India is 30.9% of interest income. If you're a US citizen, have fixed deposits in India, then it's 30.9% will get deducted on the top. Okay, moving along to slide 24. Here's a great example that I wrote up, and I do a lot of teaching across, and so that's why these examples come in handy. Okay, slide 24. So you have an interest on fixed deposit income 30,000. You have dividend income of 10,000. So your total Indian income 40,000. Now, assuming a 30% rate in India, you'll pay 9,000 tax in India only on interest, because dividend is not taxed in India. And I wanted to make sure everyone understood the math, and I just didn't make a mistake. So it's not on the total income. It's only interest income. Dividend is free in India. Now, when it's in the US return, you'll have a salary. Let's assume you have a salary of 200. You'll add your total Indian income and not just the dividend, total income. So your global income is 240. Assume you're in the 35% bracket in the US, your tax will be $84,000, but you will get credit for that 9,000 you paid in India. So your net tax payable in the US will be $75,000. Okay, very good example, and we'll try to send out the slides to everyone on the call so they can benefit from this knowledge and advice. Okay, moving along, slide 25. Okay, here's a good example of, and I do a lot of international tax planning. So let's say you have a rental property in India and you get your monthly rental on the 1st of the month. So in December, I would advise the client, why don't you pay me on Jan 1st of 15 instead of December of 14? Okay, so now you're able to defer 1 month of income because the US is based on a calendar year, whereas the Indian tax year is based on a March year end, so in the Indian tax return, it will make no difference. In the US tax return, it will make a big difference because your entire income will get deferred by 1 year in the US. So great planning tool because US follows a cash basis calendar year and US and fiscal year in India. Okay, moving along, slide 26. Okay, now here's FatGuard. This is still a chance. I come across a lot of clients and they call me all across the country and sometimes across the world, and we've done more than 50 of these very complicated cases to very simple. Now, there's still a streamlined procedure, 5% penalty, and you file 3 years amended, 6 years FBAR, but you need to document the reasons for non-compliance or omission. You cannot just file and say nothing. But more often than not, I put it when we file these FBAR forms, we mentioned that the client was not aware of these compliance rules. Now below 500,000 makes sense. Above 500,000, it is a harder case to prove that you had no knowledge of these funds abroad, and it is a little harder to prove your ignorance. And if you didn't file Indian returns, then that becomes even more complicated. And if it is non-willful, so you still avail this FBAR procedure is still available. It's called a streamlined FBAR procedure, but you need some expertise in this area to go to the right CPA or attorney to do this for you, because if they don't do it right, you get into a more tangled mess. But I want to re-emphasize non-willful. If you're fully aware and cognizant and you're aware of all the, because I've had a lot of people who have come and I've given advice, and sometimes they are not forthcoming and they get into real trouble down the road. So let's keep that in mind. Okay, slide 28. Okay, so here's mutual fund companies. They also have stopped, most mutual fund companies, for my recent advice and trips, people have told me they stopped accepting US investors. Know your customer. In India, they're going to ask you several questions, including your social security number. They want to know if you're legitimate, and they want to actually track your US operations on the India side. And then NRO accounts, 30.9% I mentioned, and then PFIC. No one has heard of this, but it's called Passive Foreign Investment Companies. It attracts a high state of US tax rate. So if you invest in Birla Fund, for example, that's a PFIC, and technically you owe 35% or 39.6% highest rate of US tax for PFIC investments. But so far the IRS has not pushed that element, but if they really want to get strict, it could be liable for the highest rate of US tax. And the definition of a PFIC is investment companies, basically that 90% of the income is earned from passive investment income. That's just very complicated international tax, not for a general audience. Okay. All right, going over to the next slide, 29. Okay, FBAR due dates moved up by FATCA and FBAR, and in fact, if you look at your 1099s, recently I've been looking at US 1099s, and on the back of the 1099, there are some good instructions on FATCA. I urge everyone on this call to read them, because it is getting tougher and tougher to, there is a major crackdown on evasion. There's a good joke I use in my tax seminar. I say the people who are involved with tax evasion go to jail. The people who are in tax avoidance, they live in Florida, or they go to Florida. So tax avoidance is legal provided you use the tax law. Tax evasion is illegal, and we should be worried about that. Okay, so moving along, slide 30. Okay, moving along here. Okay, here's a good one, slide 31. Is your corporate structure or legitimate or appropriate? And I have picked up several clients where the inappropriate structure. So Schedule C, LLCs, S Corps, you've got to figure out what's the best, we call it pass-through entities. What's your best structure and what's more relevant to you as a business? How would you want to structure a transaction? To me, that will help you save a lot of tax down the road, but planning is important in understanding your tax structure. If your structure is wrong, then it's downhill from there. You cannot salvage the day. Healthcare, 1516, we're going to talk about that briefly, and it's considered non-taxable benefit to the employee. I think in all the chaos of Obamacare, etc., people don't realize if the employer pays your tax healthcare, they get a benefit by deducting it, and the employee gets a tax-free benefit. In fact, in the 1940s and 50s, that's how it came about. They didn't want to increase salary of employees. They just wanted to give them free healthcare, or 80% his employer and 20% employee. And then finally, pay your estimated taxes and adjust your withholding, or adjust withholding, but don't leave too much money with the government. because I think you can use your money better than the government can. They hold it in trust for no interest. So in the client I referred to earlier in the seminar, you're talking about, 15,000 with the government earning no interest. Had he taken that money and invested in stocks, he could have been like for at least $1,000 ahead perhaps. Okay, moving along, slide 32. Okay, section 179, we spoke about healthcare premiums tax-free to the employee. Consider subsidizing healthcare premiums. Some of the clients that I have, doctors' offices, small businesses, they just pay some amount of premium. And the good rule is you should pay above 50%, less than 100. Most companies do that, and then you can claim a deduction. There's also a tax credit allowed for small businesses. People forget about that. So if you pay the premium of your staff in a small practice, you can get a deduction. 401k, retirement plans, excellent for if you want a major deduction. And year-end bonuses to create loyal employees, including some doctors' offices. I always advise them, why would you pay the money to the government? Why don't you give your staff a bigger bonus, 2 weeks, 3 weeks of payroll? That way, instead of paying a higher tax, you at least get a bigger deduction. Then lastly, the challenge between dividend and salary. There's always a challenge, and IRS can come back and say unreasonable salary. So you got to pay yourself reasonable salary if you're a sole practitioner or you have a small business. Okay, we're moving on to slide 32.
Oh, we are on slide 32. 33?
33, sorry. Right, okay. M&A with India and US companies. This, I think, is going to explode in the next few years. I deal with a lot of companies more than individuals. The tax structure is important to become tax efficient, but the last one, I tell you that most US companies want to do business in India, and then Indian companies wanting to do business in the US. That becomes very complicated. And most Indian companies do not understand the US tax law and vice versa. So US folks don't understand the Indian tax law. So my practice deals primarily with a lot of companies exploring opportunities, how to structure a company in India, how to structure a company in the US. And my background as a chartered accountant and a CPA helped me to do both sides. In fact, sometimes I play liaison with the Indian chartered accountant and the US CPA, and I'm able to bridge both sides and come to a reasonable conclusion. Now, here's another good one that 99% of the people don't know. If you are a US citizen or resident and you own 10% shareholding or a director of an Indian company and a director, you need both 10% shareholding and director. Even if for a private company, then you have to file a form called 5471. And I can bet you can go to any CPA in the US, I would say, other than people who are practicing in international tax, they cannot even tell you what this form number is or what it does. And that is why you need to have some expertise on international transactions if you really want to get your tax return right, especially in cross-border transactions. Okay, moving on to slide 34. This is a very complicated area called base erosion profit shifting. This is more for the Apples of the world, where they move profits from the US to Ireland and countries that have a less heavy tax burden, or the Cayman Islands, etc. So that's called profit shifting. And base erosion, governments are very protective. In fact, you read summaries of the G20, and they're very worried that a lot of people are moving money across the world and not paying their fair share of tax. Europe is particularly worried about that area. Next one is, but that's more for corporate to corporate, less for individuals. PFICs, passive foreign investment companies. So don't be surprised if the government comes down a little harder on the foreign investments. So if a US citizen owns Birla Fund, I'm just bringing that as an example, then the tax rate on that investment income could be as high as 39.6% as opposed to the 20% on passive investment for US companies. Dividend repatriation to US for US companies, that's also very complicated. So if a US company earns all their money abroad, then they are not liable for US tax until they repatriate the dividend back to the US. So GE India does not have to, if they don't repatriate the money back to the US, then it is tax free in the US till such time. So $2 to $3 trillion is sitting outside the US from all multinationals. That's one of the major loopholes in tax. I wouldn't call it loophole, but they wanted to have the multinational expand abroad, and that was some of the reasoning why they introduced this. And this goes all the way back from 1961. It's not today and yesterday. Okay, moving along, I'll have time for question and answers. So 35, healthcare. Just move along. Okay, slide 36, important. Healthcare has to be carried by all individuals. You should receive a form called 1095 A, B, or C. If you must be covered by an employer, you must, or you must buy your own insurance to a federal or state, and it should be reported on a W-2. You should see as code DD. A penalty if the individual does not carry insurance on your 2014 and 2015 return. Companies above, if 14 was above 100 employees, now in 2015 was above 50 employees. Okay, let's move on to slide 37. And there's a penalty for 16, it's $695 per individual and $2,000 for a family if you don't carry insurance. Okay, returns must be filed to avail of healthcare credits. This is more for people who get subsidies on healthcare for, you know. Okay, 38, slide 38. Okay, so this is an important mandate. So for 15, it was more than 100 employees, 16 more than 50, and then dependent for this purpose is age 26. So you can cover, one thing good about Obamacare was you could cover a kid who was less than 26. Before it was only 21, so now till 26. So, but everyone, they're going to enforce this mandate real tough. So folks, line 61 of your tax return should read, they ask you a specific question. Did you have insurance for the full year? You and your family or independents claimed on that return, and you have to check off that box. The IRS hasn't been strong on that, but I can bet you in the next year or two they're going to start chasing that element when they have step up their resources to see enforcement is taking place. Okay, slide 39. Okay, I won't go through the whole exercise. It's fair to say, and these slides will be sent out. So let's assume just quickly they have less than 10 employees. It's a burden on the employer. But if the employer contributes 40% and employee 40 and employer 60, then you can also get a healthcare credit for this and lower your taxable income. So moving on to slide 40. Okay, these are all the forms. I wouldn't go crazy, but I wouldn't inundate you. But we call it minimum essential coverage, and Form 1095A. You have to send a form to the government. So all employers are reporting to the government, folks. Two things I want to just re-emphasize on this call is that the employers with more than 100 employees have to report to the government, just like they did the W-2s. And the same thing with FATCA. So as soon as they have these the FATCA responsibility is on the person paying the money. So all the banks and financial institutions have become very strict with compliance, because if they mess up, then they are going to incur a 30% penalty, and no bank is ever going to take that responsibility. In fact, some of the banks have even stopped accepting foreign deposits here in the U.S. They say we don't want to deal with this area. I cannot name banks, but I know at least 4 banks who have closed down their foreign operations completely because they have been indicted a lot and they have had several cases of people moving money outside the country. So they don't want to deal with that whole area all over again. Okay, moving along here. And that's our contact information. So feel free, and I'll open it up for any questions. Nancy, and we'll take any questions we have.
Yeah, Cecil, we have a couple of questions that came on the chat.
Okay.
Right. The first question is Ralston Sequeira's question regarding FBAR. Is
Yes.
the $10,000 amount per account or total value of all accounts in India?
Each account.
Okay.
So but it's combined. If you exceed 10,000, yes, it's a 10,000 is a threshold.
Yes. So your net total amount in the account should be 10,000 or more.
Correct.
Right?
Dollars, US dollars.
Yeah. Okay. So the next question is, can we have a Roth account and a 401k at the same time?
No, you cannot.
Okay.
You take that back. You can, but there's strict limitations. The 401k actually is superseding. You cannot have both because you cannot have 2 retirement accounts.
Okay. So if you sell a long-term, it's a question from Eric. If you sell a long-term capital asset and TDS is deducted, then can I offset the tax paid in India against my US tax?
Yes, first you have to file the Indian return. Okay, then you'll include that gain in the US return. And then, yes, you can equate that gain against a loss because you're taxed on worldwide income. So your profits and losses will be set off against each other.
Okay. Uh,
So let me re-emphasize that worldwide income on your US tax return, you're on worldwide income. So the Indian income will be included, and if you have the US loss, US income can be set up against Indian loss, or vice versa. But up to $3,000 for long-term capital gain or loss.
okay. And a follow-up question from Brian D'Souza says, what if we have promptly filed Indian taxes every year? How does this help?
I didn't follow the question. So
The
repeat the
question,
question.
what if we have promptly filed Indian taxes every year? How does this help?
It helps because you can, if you have F-bar issues, how would you include? You have to include the Indian income in the US return. The India return is okay, but it's very helpful because you can make a case to the IRS saying, we filed returns every year in India. I had a client who had filed from 1972. And when I appealed to the IRS, they were very lenient. They said, okay, he had deliberate reason to believe, but his accountant in the US made a mistake and did not realize that the Indian income was taxable in the US. So he got favorable treatment because they could see evidence that he was trying to comply, but his issue was the accountant was at fault and did not include the Indian income, and the client was at fault not telling this US CPA that it should have been included.
Okay, so another follow-up question was if you have 10K in one account in India and you have 5K in another account in India, can you declare only one or do you need to declare both?
No, if you're in the form, you might as well declare both. You're technically you'll be you compliance even one, but you would rather declare both than show one because if you get into issues, but technically it says if the form has to be filed, it is not by account. They focus on if you own more than 10,000 in any foreign bank account. It does not specify one bank account. That
Okay.
way you can show $2,500 in 5 bank accounts, right? So you
Yeah.
still be in violation when you add up all the accounts. So you should any foreign bank account more than 10,000. This is just a blanket rule, you know.
Correct. A follow-up question from Paul was for NRIs, there is no TDS, right?
Some banks impose, some don't. So irrespective, if some do, then you can avail of it. In India, if you file the return, they'll give you a refund. But you cannot claim the TDS if you claim the refund in India. Now, if you didn't claim the refund in India and if TDS is deducted, then you can file your US return and claim the TDS and get the money back. So you will have less taxes to pay in the US. It's
Okay,
called a setup.
so there was a related question that came up from Rodney, and he asked if the Indian income is non-taxable, then and you don't end up paying tax in India, but does it mean that you need to add it to your US tax income and then pay tax on it?
Depends on what income it is. See, you're going through two different tax laws.
Got it.
Okay, first you go through Indian tax law. Okay, and now if Indian exempts it, for example, dividend is not taxed in India, but it is taxed in the US. So the fact that you got dividend income in India is not going to exempt you from US tax law because you're a US citizen. So that example, if you go back to the slide where I had the workings, you
Mm-hmm.
see Indian dividend was not taxed, but when you file the US return, you have to include that dividend and it will get taxed at US tax rates.
Okay.
Okay, another question was, what do we do if we don't receive a 1099 from Indian banks? How do we report the income?
You just got to call the bank and find out how much interest income you earn. Indian banks will never issue 1099s. They don't have that requirement.
Okay,
Okay.
You just call the bank and ask them for the statement or find a relative in India who can go to the bank and get that information.
A question from Kevin DeCosta was, how about joint accounts with parents based in India? Do we need to submit an F-bar for those accounts?
Do you have signatory authority on the account?
I
Question.
think that's the assumption.
Yes, if it is, yes.
Okay, and does it make a difference if you're like the first to sign or the second to sign?
Doesn't matter.
Doesn't matter. Okay.
The word is signatory authority in a bank account because that person can withdraw all the funds, right? So let's say you have 20,000 in the bank and your parents are first and you're second. You still have signatory authority. Something happens to your parents, you go and sign, and you can withdraw all that $20,000. So you're 100% liable on. You have control over that bank account as soon as you have signatory authority.
Okay. A question from Manish, I think that came up is, could a person having a PF account in India be considered as having a PFIC?
No, that's not in the same vein. The Provident Fund in India is more in the nature of a 401k plan, retirement account, and not in the nature of a PFIC.
Got it.
PFIC is very complicated. They haven't enforced it, but 99% of the people don't know about it. But I practice in international tax law, that's why I know, and that is a little more complex. But if they start cracking down, they can technically levy those penalties on Indian mutual funds.
Right, and I think the Indian mutual funds, the reason, again, there are different types of mutual funds, and some of them are very easy to figure out
Yeah,
because invest give you the dividend back, but they invested back into the fund.
I know. It's the same thing here too. Even here in the US, the mutual funds, they just roll over all the dividends, so it's hard. But what I recommend is you take the cost minus the sale price. That's how you would want to record those transactions.
Yeah.
So whatever you invested in the fund, you invested 10,000 in a mutual fund. If that became 15,000, then 5,000 is your gain. Period.
Yeah.
Right. So either you have to record the dividend that they're issuing, or you record the gain when you sell the asset. That's all.
Right. So we have a question about Section 179 from Brian D'Souza.
Yes.
He says, how does it apply on luxury cars?
No, that's limitation on luxury cars. So you will still allowed, but there's a limitation. You have to go to section, I believe it's 280F in the US tax code, and you have to read there are certain limitation on luxury cars. In other words, you buy a car, a Tesla for 70,000, they're not going to deduct it. They'll only allow you to deduct up to $25,000, I believe, or in that range. On a phased out basis, so it'll be about 5,000, 7,000. But the tables are right there in section 280F of the tax code. It'll mention all the each year how much can you deduct.
Okay, and that table would give us like the maximum amount?
Yes, yes.
Okay.
It's 280F if I'm not mistaken.
280F. Okay, thank you, sir.
All right. So the next question comes from Mark.
What? There are more questions than the slides I had, man.
Hey. Okay. So it looks like there are a lot of people here who have issues with India and US taxes. So the question from Mark is, can we deduct expenses in India against income in India and only report the net income in the US?
No.
No.
Okay.
The advice is here. This income and expense related to some property or business, right? So you have to first file the Indian return. I always recommend file the Indian return because that becomes the basis of your US return. Even if you don't have income in India, my honest suggestion, file a return. It might cost you $50 to $100. The good news is the IRS in the US always treats those foreign returns with, as compliance. And they say, if this person had complied in India, now the case is less vulnerable. So if you have other transgressions, you still be forgiven because you filed a return in India. But if you did not file in India, then the case becomes a little harder to prove. So I'd recommend, even if in all our clients we file in India, irrespective, we tell them just file a return. So now we have good track record of 3 to 5 years saying, hey, client filed the return in India, here's the US return, and here's how it works together. When they sell property in India, first thing I tell them, pay the tax in India, use your Indian rupees, right? And then, file the Indian return, then include that same gain in the US return, and then you can show compliance, in India and in the US. And you get credit for what you paid in India. So it's not double tax, that's all.
Yeah. Mm-hmm. So we have a question on FBAR.
Let me step back. Sorry, did I answer the question? So that business income and expense, first file the Indian return. You'll have to report the same thing. If it is a business, it will be Schedule C. And if it is a real estate, it will be on Schedule E, E as in England. Okay. And so you need to report that, and then accordingly it will work out.
Okay. So going on to an FBAR question.
Yes.
A question from Eric is, if I hold a power of attorney for someone in India,
yes,
is it considered as a signature authority for FBAR purposes? And would those accounts need to be included on the FBAR?
That's a little more complicated. You'd have to talk to an attorney or go call the IRS directly on that. A power of attorney, in my opinion, if you have power, what they my honest opinion on this one would be if you have power to withdraw the funds, then you have power over the bank account. But if you don't, so if you have power of attorney to withdraw the funds, that would be my threshold, and then FBAR would apply.
Yeah, which means you are now a signatory on the account, right?
Correct, correct. In other words, see what the IRS has always maintained. Why do they want you to report all these accounts if you have a power? I had cases where the kids, grandkids, man, I'm talking parents are in Indian origin, but grandkids had signatory authority. They opened these accounts with grandkids' names, right? But as long as a grandkid is mentioned as a signatory or a beneficiary, even as a beneficiary, they have held that FBAR applied. So
Uh,
power of attorney, I think, in my opinion, but you would have to clarify. My opinion would be, I would lean towards filing the FBAR.
yeah. Now, there's also in India the concept of nominee. Does
Yes,
that apply in for FBARs?
I don't believe so. I don't know the exact context. I would have to read the facts and circumstances. I could not give you an opinion on that one right now.
Okay. All right. So a follow-up question on the FBAR thing is, what if the power of attorney is a general one? Does that matter?
If you can, the question to be asked is different. The power of attorney, can you withdraw the funds from that bank account or not? And if the answer is yes, you are in FBAR territory. If the answer is no, the power of attorney is to execute something else. But if it's to liquidate assets, then you're definitely you have that, you know. But it's different from giving the power of attorney to, like, say, an attorney. Now, non-related attorney. But if you're a related party, then in my opinion, your son, daughter, brother, sister, then why would you give a power of attorney to someone? The only reason you would give it is because they can execute a transaction in case something happens to the original person. That's the whole reason of a power of attorney. So if you have entitlement, you can withdraw funds. In my opinion, you're in FBAR territory. If you don't have authority to withdraw funds, but to have general control over other stuff, then not relevant.
Okay. So moving on to filing income tax returns, Dilip has a question about proration. So if I file an income return in India from April to March 2015, do I need to prorate the part for the US tax year?
Yes,
Okay.
because US follows a calendar year strictly and cash basis.
Okay.
And by that I mean income received or paid in cash. But cash I mean bank, you know what I'm saying? So if you collect rent, as soon as you collect the rent, it's considered income. And when you pay expenses, it's considered expense.
Okay. And we also have a question on gift tax from Brian.
Okay?
So on the $28,000 for two kids, what is the tax
No, no,
break the
one
parents
kid.
get? One kid. What is the tax break the parents get?
No tax break, there's no gift tax.
Right.
So you can technically reduce your wealth and estate, correct? So let's say you're really rich and you have 15 million of income, right? So how are you going to transfer this wealth to the kids? You cannot, because it's 40% estate tax.
Right.
So if you start 28,000 every year and the kid, you give it to the kid for 10 years, you're talking 28,000 to each kid plus grandkid or whoever, right? So that's a lot of money.
Yeah.
You can actually reduce your taxable estate and give it to the siblings. And I've had several cases like this, folks. Today, the issue is not about wealth; it's about transfer of wealth and how best to transfer it in a very logical and systematic way. And I think that 28,000 is the most unexplored territory. So and now the kid starts earning income, right? Not you.
Mm-hmm.
So let's say you're 28,000, 280,000. Let's say you invest in stocks for the kid, and that kid, that goes to whatever amount, say maybe a million in 25 years. I don't know, but it's all in the kid's hands and not in your hands.
Right.
Right now, if you keep holding on to your wealth till you die or retire or whatever, it will be taxed at your high rate of taxation, and there's no transfer of wealth. A lot of people, and I've come across several folks. I don't mean to minimize this point, but that's a really important slide. And if you set up a good path of kids and grandkids, you can transfer close to $1 million gift tax free and estate tax free. That's my whole point in this.
We just want to see if there are more questions. And just a follow-up question. Does it matter if the parents are US citizens or US residents for the gift tax purposes?
No,
Okay.
You can give it to anyone. There's another form I didn't mention here. There's a form called 3520. Okay, for people on this call. 3520 is a gift tax form for the IRS telling them what is the basis that you're doing it. Now, for the 28,000, you don't need anything. So what I advise all my clients, you open a gift account for each of the kids. You name it A's gift, B's gift. So every year you contribute 28,000 into that account. Done, right? But if the amounts exceed that, so for example, if you give 50,000 to a kid, then you technically have to file a gift tax return, and that form is 706. But there's another form with the IRS. So say an international person, so some Indian parent gave you $1 million in the US, then you should file a form called 3520. And it's a gift tax, telling the government that you received this 1 million gift from someone there. Now that this also applies to death and inheritance. Okay, people make this mistake, and I want to take one more minute. So let's say someone bought a property in 1960, the parent, and they died in 2010. And the value of the property is the parent bought for 10,000. Now it's worth 1 million, and this property got sold in 2015 for 1.2 million. So if you file that form called 3520 that you inherited that property at 1 million, then your gain is only 200. But if you didn't file that form, the IRS can come back and say, "Oh, this is $1.2 million gain," and that's where it's dangerous. So you need to talk to people who specialize in a comprehensive package of advice, international, gift tax, estate tax, structure your transactions more appropriately, and that way you can really use the tax law to your advantage.
And we also want to say that, this is federal law, right? States
Yes,
could have different law too.
correct. Correct. Also, for example, see now the tax credits only apply to federal. Okay, so what you pay in India, tax deducted at source. Okay, only federal to federal you'll get credit, but states you still have to pay a share of tax. So, for example, in New Jersey, 6% or 7% tax. So that dividend will get taxed at 7% in New
Yeah.
Jersey in addition to the federal. Or interest income, if it's TDS, you'll get credit federal to federal, but state you still owe that money.
And the main reason is because the states are not signatories to the treaty.
That is correct. No, they don't. They don't comply with it.
Yeah,
How can you get credit for both, right? You cannot get on federal and state for the same. So
correct.
you get federal to federal. You cannot have state is a different entity all by itself.
Yeah.
Now that's why I live in Florida or Texas or someplace that doesn't tax, or Washington State or somewhere where they don't tax you.
Yeah, but you got established residency there before you get the
Yes,
gift or
yes,
the
that's
income.
correct. That's correct. That's correct.
Right. So a follow-up question from Brian is, with regards to gifting your children, what if the kid is minor? Does he still have to file a return?
No, you don't. For 28,000, you never have to file a return. That's my whole point here. Above that, yes.
Okay.
Above the threshold. Okay, so you can go to the bank and open an account for your kid for $14,000 tomorrow. It's called gift to minor.
Okay.
So very easy, and they cannot avail of any of this. But after they are 21, they can technically that is theirs. Okay, you can show it as a gift. So you can apply it to parents, gifts, anyone. You can have the gift is always available, $28,000.
So, and in with regards to gifting to kids, Eric has a question regarding FAFSA. Does this create issues for FAFSA purposes?
Each one has their own take. To me, it does not. If the kid has income, that could be included here. You cannot. FAFSA is a totally different thing. What is it? They look at what is your income of the parent, what are the income of the kids. So by gifting it does not eliminate that possibility. You have to include the gifts, the gifts made too, right? So that's total wealth of the family and deciding financial aid.
Okay. All right. I'm not seeing any other questions in the chat. So guys, if you have any other questions, we have 5 minutes left. So if you have any questions, just post it in the chat and we'll ask Cecil the questions.
I think apart from questions, Cecil, a lot of people have just thanked you because I think this session has been extremely informative. And I think you've given us like all the hidden pieces of information that we either tend to miss or we're not aware of. So I'd just like to say that as well.
Now, don't get me in trouble, whatever you guys do. So all advice is only what you pay for. No, I'm just kidding. What you want to do is just, I honestly, everyone on the call, I do major sessions all over the world, and especially on international tax. I really urge you, try to do the right thing, get the best person that is very qualified to help you. Doesn't have to be us, but make sure you get the right answer. Make sure you're comfortable. There's one thing, I've been in the US for 30 plus years. My suggestion is I try to get the best advice. I'm also not the best. When we are as a firm are confused with an issue, we go and seek the help of a bigger firm that knows the right answer to stock options or to complicated wealth transfers. It's better to get the right answer. And in this country, you can get whoever the expert you want. And I teach on the international circuit. I knew FATCA and FBAR like 5 years before it actually happened, because I specialize in this area and I teach, so I know, and I teach US CPAs. So I try to get the best answer possible for our clients. And if we don't know the answer, we tell the client, we don't know, but we'll consult and we'll try to get you the best answer possible. So it might be, I feel it's penny wise, pound foolish to save yourself a few bucks here and there, and later on realize that transactions were not done correctly or information not reported correctly. And one thing I forgot to mention on FBAR, if they find you first, then you cannot get into any FBAR program. Okay, so if they know for a fact you have a bank account and you deliberately not come forward, and they send you a notice, then you cannot avail of all the voluntary disclosure programs, because then it is, you cannot come up front and say, oh, I forgot and all that, not happening. And we've handled very serious cases, in this area, including 3 of the most difficult cases, and the people are in jail for that. So I urge people, do the best thing you can, so that you get the right answer, and if we can help in any way. And I want to mention one more thing. And when Mark approached me with this, I'm from Bangalore originally, so we 3 brothers, we are very committed to giving back. We have been very grateful and thankful for all the opportunities we've got. And, so giving back to the community is always a great thing. And we never charge for that. And we just think it's our duty and obligation to take care of our community first. So I appreciate the opportunity. And if there's any further questions, feel free. You have my contact information. Happy to do the best we can. Okay.
Cecil, we just have, if you have 2 minutes, we have 2 more questions.
Questions are over, man. Question time over. You send it to the next presidential candidates. You might get better answers than I can give you.
It depends on who comes, man.
That's what I'm saying. So I couldn't answer that.
So
all right, go for it.
All right. So it's a question from Eric. If I don't have taxable income in India, do you still recommend we file a tax return in India? If I start doing it now, won't it create a red flag by income tax authorities in India?
No, if there's no income, why would you file? There must be something in India, right? Why are you asking the question? If there's no income, nothing. Right. If there's income, there's you cannot file a return with 0. But if you have interest and dividends, sometimes they're below the threshold, you can file a 0 return in India. Because some people do have, India has a threshold to file. So let's say you make 10,000 rupees of 100,000 rupees, which is really nothing in India, right? You can still, the IRS does not, the Indian government does not prevent you. And there's no red flag because there's no tax. But, if you want to be clean on that side, but normally if you have some amount of income and you're not sure, you want to file it, it shows compliance on both sides.
Thanks. All right. Thank you so much, Cecil, for taking time out of your busy schedule.
No problem. No problem.
And it was a very informative session.
Yeah, thank you. And any further questions, happy to respond. And here's our contact information, so you can send it out, and we are happy to help the best way we know how. Okay, thank you very much.
And for those attending, we will be sending out the slides as a PDF in the next couple of days. And if you have questions, Cecil and his company's contact information is on the slides. Please feel free to reach out to them to set up a consultation.
And let me add one more sentence, folks. All this is educational purposes only. Each one, facts and circumstances are different, so we cannot take this as legal advice. So if we understand your fact pattern, it's only informational and educational. We have to say this because I do a lot of these sessions, and it's not tax law. We do the best we can explaining what the tax law is. So we don't want to be held in a lawsuit saying that this was what was guidance provided. So you need to consult your local CPA attorney. But 99% of the stuff we have delivered is based on tax law. Okay, so we have to make that disclaimer available. Okay, thank you very much and have a great day.
So,
You too.
Okay,
Thank you.
all right, bye.
bye, guys.